Hello everyone, the topic that we are going to take up for this session would be bonds, their analysis and valuation. Since we're just getting started off with bonds, and I would like to believe that most of you would not be very familiar with bonds. So let me just go slow and spend some time on the kind of instrument that bonds are. We all know that as a business entity, one would need funding, okay? So be it a company or a sole proprietorship or a partnership, we would need fund, and that fund could be arranged by way of taking a loan from the bank. You could take a loan from your friends. You can get partners for your business who would be willing to put capital into the business. So in that case, they become the co-owners of the business. And from a company's perspective, one could raise money from prospective shareholders. So I can issue shares, I can issue stocks, and I can raise money. I can issue bonds and I can raise money. Or I could take a loan from the bank. The difference between taking a loan from the bank is that I take a big substantive amount from a single entity or from a clutch of entities. And unlike a bank loan, when I issue bonds, which again is a debt instrument, I repeat, when you issue bonds, you are still taking loan from the bond investors. But unlike a bank loan, there you have multiple investors, multiple lenders. So a bond is a debt instrument. That's an easy way to understand it. And when I issue a bond and I raise money, I'm essentially borrowing money. So a bond investor is a lender, and the issuer of the bond is the borrower. So simply put, a bond instrument is a debt instrument. So few key things that needs to be remembered. One, bond is a debt instrument. Bond is a debt instrument. A bond issuer is the borrower. So generally it's a company, it's a corporate, or it could be a government as well. So bond issuer is the borrower. So he issues a bond, he issues a debt instrument. So he issues a bond, okay? And the bond investor in turn gives money, lends money. Okay, so a bond investor issues a bond issuer issues a bond to the bond investor, and the bond investor in turn lends money to the issuer. So when a bond investor is investing into a bond, he is essentially lending money to the issuer. Okay, that's a very simple way to understand it. So this bond is nothing but a debt instrument, right? Now, why would a lender be willing to give money to the issuer? Because he is interested in interest income. He is interested in getting more than what he has given. I mean, that's what the lender's interest is. The lender's interest primarily is in interest, is getting interest, right? So once the issuance have taken place, over the next few years, you will see the bond issuer giving back to the bond investor a certain amount of interest, and at the end of a certain period, let's call it maturity, he will repay back the initial amount as well, which is the principal. Okay, so you would say, sir, that sounds very much like a normal loan, and that is how we need to take a bond as. So bond is nothing but a standardized loan instrument, and the purpose of issuing bonds instead of taking loan from a bank is basically to create multitude lenders rather than a single lender, and to that extent your credit risk as well gets spread, right? So instead of one bank being exposed to the company, you will have multiple investors like you and me who would be exposed to the company risk. So to that extent, the risk kind of gets distributed amongst multiple investors. So that is how we will understand bond instruments as. We will understand them as debt instruments. Now let us get comfortable with the bond terminology. Okay, so a few things that we need to understand with respect to bonds. And I shall take an example. Let's say a company issues a rupees 100 face value. I repeat, a company issues a rupees 100 face value 10% 5-year bond. So a company issues a rupees 100 face value 10% 5-year bond, or let me be a little more elaborate out here, a 10% annual coupon 5-year bond. And let's say it has issued it at par. So how do we interpret this as? What does it mean to me as an investor? When I say a company has issued the bond at par, that basically means that the face value of the bond is rupees 100 and it has been issued at rupees 100. That means the person who is buying this bond from the company is buying it for rupees 100. Okay, so we are talking about the primary section of the market where the investor subscribes to the issuance and has decided to buy the bond from the company at par. That means whatever is the face value of the bond, that is the price that you are willing to pay for this bond. So when it has issued at par, that means the issuer has sold this bond at rupees 100 at a price which is equal to face value. Now, having sold it for rupees 100, what does it mean for an investor? Let's look at it in terms of cash flows. That means today he pays rupees 100 for this bond. He has paid rupees 100 for this bond, and in turn he has made himself eligible for a series of cash flows. What cash flows? What is the coupon that this bond promises to give to the investor? 10%. Now 10% is with respect to face value. So 10% of rupees 100 is 10 rupees. Now that is what an investor would get every year. Why every year? It's an annual coupon bond. It's an annual coupon bond. So every year on from now, you will get 10 rupees. So 1 year of investment, you get 10% of rupees 100. 2 year, another 10, another 10, another 10. And since it's a 5-year bond, you will keep getting this coupon for those many years. So for 5 years. And given that it's a 5-year bond, it basically means that the maturity period of the bond is 5 years. That means it will get redeemed at the end of 5 years. So out here, the company pays back rupees 100 to the investor. I hope you can see it. The company pays back rupees 100 to the investor. So for an investor, this entire description would result in these potential cash flows. Now it's for the investor to decide whether he is willing to go for it or not. An outflow of 100 and in turn will result in an inflow of these cash flows. So let's again go through the basic terms. Face value is the amount with respect to which the coupon is calculated yearly in this case, and again is indicative of the amount that will be paid back at the end of the period. What is the maturity period? 5 years. So that's the life of the bond. Unlike a stock, a bond has a definite life. Unless and until it happens to be a perpetuity bond, okay, it will have a finite life, in this case 5 years. So that kind of explains it all. It has been issued at par, which basically is indicative of the price at which it has been issued. Now, sometimes students because they're still not out of the time value of money hangover, gets a little confused when they see that the cash flow out here is 10 rupees every year. They argue, sir, we did learn that there is a power of compounding. So if it's 2 years, shouldn't I be getting not 10 rupees but a little more than that, because there will be interest on interest as well? Well, the answer is a firm no. So you've already got back the interest for the first year. So 10% coupon, as and when generated, it gets paid back. So the outstanding is still rupees 100. Okay. So in this case, of course, there will be no compounding because the coupons are being paid at regular intervals. I hope you get it. So that's one very basic example of what a bond could look like. Let me take another problem. Let me take another situation. There could be a bond which is not an annual coupon bond but a semi-annual coupon bond. So let me just make a minor variation to the same problem, which is that instead of this bond being a coupon bond, it's a semi-annual coupon bond. And that's how the Government of India bonds are. A semi-annual coupon bond. So what will the cash flows look like? 10% semi-annual coupon bond, that means every 6 months. Every 6 months. So Y 0.5, which is 6 months, Y1, Y 1.5, Y2, and till Y5. So it kind of goes on. And what is the cash flow that an investor would get? Since it has been issued at par, he pays rupees 100, and what he gets in return is a 10% semi-annual coupon. Now do remember, coupons are always indicated on an annualized basis. So 10% is for the entire year. For 6 months, it's going to be 5%. So I get 5 rupees at the end of 6 months, another 5 rupees at the end of 1 year, another 5 rupees at the end of 1.5 years, and so on and so forth. And in the final terminal year, at the end of it, I shall get 105. So this is how my cash flows are going to look like. Unlike the previous problem where we had annual coupon, out here we shall have semi-annual coupon. So we realized that the two major participants in the bond market would be on one side the issuers and on the other side the investors, or the so-called participants, or the so-called authorized participants who are allowed to invest into bonds. Now let's talk a little about the issuers. Who could be the potential issuers of the bonds? Now you would reckon anyone who need finances would be looking forward to issue bonds. So entities large which would be in need of big funds would issue bonds. So the names that immediately strike our mind is one, the government, right? So in India it could be the Government of India, which would need money and hence could potentially issue bonds, and that is what it is. You have Government of India securities which are issued by the RBI to raise money for the Government of India. So effectively it's the Government of India borrowing money from the public. The other entity which or the other section which issues bonds happen to be the corporates. So big companies who would be needing money could issue bonds, and it could be people like you and me who could subscribe to those bonds, right? So that helps us understand that there are essentially two large categories. One is on the basis of issuers. One is the government bonds and the other is of course the corporate bonds. So that's one way of understanding the classification of bonds, which is on the basis of who is the issuer. Of course, if you go beyond India, there are other categories as well. You have municipalities issuing bonds known as the municipal bonds. You have mortgage agencies issuing bonds which are known as the mortgage bonds. So the agency bonds. So we will stick to these two basic categories, which is the government bond and the corporate bond. Also understand that given that when the government raises money from the public need not be worried, the investors need not be worried about the possibility of default. So if I'm investing into a government bond, I would not be worried about the possibility of the government of India failing on its obligation to pay back money to me, for the simple reason that RBI, being the banker to the government of India, could always print money and help the government of India to refinance the payments of these bonds, right? So as far as the local currency bonds which are issued by the government, one need not worry about the default risk at all, because it does not exist. Coming over to the corporate bonds, of course there could be a possibility of default. Now that is also a function of the credit worthiness of the corporate. So good blue chip marquee corporates would rarely default on their bond obligations, but distressed companies could always do so. There could be delayed payments, there could be failure on the part of these companies to make payments, and in that case we are talking about the junk section of the corporate bonds. So based on issuer, these are the two categories that we need to understand. In terms of maturity, it could be very short term debt securities, debt instruments, it could be medium term, or it could be the long term bonds, right? So very short term securities of 1 year or less than 1 year, generally issued by the government, are known as treasury bills, okay? And beyond 1 year, they are known as treasury notes or treasury securities or treasury bonds. So that's another way of categorizing bonds, which is in terms of maturity. And third, in terms of credit worthiness, so we could look at another category, which is very short term, medium term, and long term. So that's another way of categorizing bonds. So this is based on issuer, this is based on maturity, and the other way of categorizing bonds is in terms of its credit rating. So bonds which are issued by very high credit worthy issuers would tend to have good rating, and the others would tend to have a very poor rating. So either it could be investment grade bonds, or it could be junk status bonds or junk bonds. So we would look at both the varieties and see how do we go about dealing with such bonds, how do we go about valuing these bonds. So that's a little about bond markets. Now moving on, when we talk about bond markets, there are two sections to it. One is the primary section and the other is the secondary section. So let us understand what would be the primary section. When a corporate goes out and issues bonds and investor subscribes to it, now this is the transaction which is happening in the primary section. So let's say a company like, let's take any company, let's say DLF, which has issued bonds and I have subscribed to it. Now that's the primary section of the debt market. Now once I have subscribed to these bonds, it doesn't mean that I need to stick around with those bonds. Those bonds might be getting traded on the exchange, and while this bond has a maturity of 5 years, even a day or two or a year after having bought this bond, I can sell it out in the open market in the exchange. Who's going to buy it? Some other prospective investor. Now, when one investor sells his bond to another investor, that's a transaction which is happening in the secondary section of the market. So I repeat, there are two sections to the market. One, the primary section, where the transaction between the issuer and the investor happens, and the other is the secondary section, where one investor sells or buys the bond from another investor. So basically there is a transfer of ownership. Now the price at which one investor would sell it to the other investor is something which would be discovered by the market. Of course, we will see how to go about pricing a bond. How do we price a bond? How do we arrive at the fair value of a bond? Now, We've all gone through the time value of money exercise, and there we did see that for me to value any set of cash flows, all that I need to do is follow a few steps. Step 1, set up the cash flows. Step 2, discount those cash flows, add the present value of the individual cash flows, get that consolidated figure, and that represents the value of those cash flows. So we will try to apply this approach or concept to the valuation of bonds. So let me take an example. Consider a 5-year 10% rupees 1000 bond. So I'm basically taking a 5% 10-year rupees 1000 bond. So what does it mean? 5% is your annual coupon. 10-year is it's a 10% 5-year. So 10% 5-year rupees 1000 bond. So let us understand. So it's a 10% rupees 1000 5-year bond. So 10% indicates the annual coupon. So this indicates the annual coupon. 5-year is the maturity, and rupees 1000 is the face value. So at times when a short description is given as such, you should be quick enough to interpret that 10% is the coupon, 5-year is the maturity, that's the time left for maturity, and rupees 1000 happens to be the face value. Now, what will it result in terms of cash flow? So if I were to invest into this bond, every year I am going to get a 10% coupon. 10% of face value. The face value is rupees 1000. So 10% of 1000 is 100. So I get 100 year 1. I get another 100 at year 2, another 100 at year 3, another 100 at year 4, and another 100 at year 5. And don't forget, the maturity of this bond is 5 years, so I'll get back the face value at the end of 5 years. So this is how my cash flows are going to look like if I were to invest into this bond. The moot question is, what should be the price that I should be willing to pay for these cash flows? So what is it that I should give today to buy this bond? You would say, very simple, sir. It would essentially be the present value of these cash flows. It should be the present value of these cash flows. Now, the present value of these cash flows would be arrived at if I know what the discount rate is. So the discount rate that you would use to arrive at the price has to be the one which will be effectively the return that you would be getting out of this bond. In other words, let's say you are absolutely comfortable getting an 8% return. So you think it's a high quality bond, and even if you were to get a return of anything like 8%, you would be more than happy to invest into this bond. So if 8% is the return that you are seeking from this bond, you ought to discount the cash flows of this bond at 8%. So let's do that. 100 divided by 1.08, 100 divided by 1.08 square, 1.08 cube, 1.08 to the power 4, and this entire cash flow 1.08 to the power 5. And then you add it up and you will arrive at the present value of this bond when discounted at 8%. Okay, the other way to put it effectively the same way is to look at 100 as an annuity, 5 such cash flows. So 100 into PVIFA, where you've taken the interest rate to be 8% and the number of periods to be 5, the number of payments to be 5, plus the present value of 1000. So it's the PVIF, the present value of 1000, by taking 8% and again 5 years. Right? So this will result in 100 into 1 by R. So 1 by 0.08 minus 1 by 0.